Some mistakes will be made along the way. That's good, because at least some decisions are being made along the way. And we'll find the mistakes, we'll fix them. And I think what we need to do is support that team.
After being ousted from Apple in 1985, Steve Jobs returned in 1997. He found the company really on the brink of collapse. There were all sorts of new competitors that were in a much stronger position than Apple. And I don't know this for a fact, but I have to think that inside the company, there was this concern about how they were really going to compete against all these factors that were really outside of their control. Bring back Steve Jobs, a bold vision, product innovation, et cetera, and look at where the company is now. Now, obviously, he hasn't been running the business for quite a while, but you can see that a bold leader with a vision came in and essentially was able to control the uncontrollable. Now, obviously, there were missteps that Steve Jobs made, and there were perhaps strategies that he could have pursued that he didn't. But at the end of the day, he was able to take that company that, again, was on the brink of collapse into a giant success and one of the most powerful companies in the world today. Today's video, we're going to talk about the differences that we see as a buyer between the business owners that make a successful pitch to buyers and those that don't. Really what it comes down to are the business owners that are able to show that they know what's going on in their business and have some level of control over it, even though in any business there are all sorts of outside factors that make growth very challenging. My name is Nick McLean. I'm one of the founders of 4 Pillars Investors. I've been in the M&A private equity space for almost 20 years now. And what I can tell you is that in this industry, I feel like so much is outside of my control. However, if I'm being honest, I really don't think that it's that much different than running any other business. You know, whenever I was CEO of Southwest Steel, all sorts of things would happen that would impact the project, impact the financials, etc. And again, you get to this point where it feels like so much of what you do is perhaps not wasted, but it's not really as effective as it can because of these outside factors. But what I learned as I continued running 4 Pillars and also in my time at Southwest is that there will always be those uncontrollable factors. However, what you have to do is you have to manage around those so that you can still grow your business even though things are going to happen that really hurt it. Stay tuned today as I talk about the differences between business owners that are able to effectively show how great their company is and business owners that struggle more. This isn't about marketing or putting together a pitch deck so that you can make your company look all snazzy. Not it at all. This is really about hearing the fundamentals of what business owners who are successful in really understanding their business do so that they have more impact on the company's growth and the company's overall profitability. First off, I want to set the stage. What do buyers like to see in a business? Well, one thing they like to see is stability. At the end of the day, buyers are buying cash flow. And if there are wide swings in cash flow from year to year, that makes it feel more risky, even if perhaps it's not. If there is year over year with steady growth in earnings and cash flow as well, a buyer will love to see that. However, if it's choppy and there's no clear trends, it's going to be a much tougher sell. Another component that buyers like to see is the owners or management influencing the results of the company. Now, this doesn't mean that they're actually winning the customer accounts or they're on the shop floor managing the operations. But what we as buyers like to see is that as an owner or as a manager, you're implementing a strategy and affecting the execution such that the corresponding results are positive and in line with expectations. What a buyer doesn't want to see or get the impression of is that the business owner or managers feel as though they're just at the whims of their customers, they're just at the whims of the economy, they're just at the whims of everybody else except for what they can control within their 4 walls. third, buyers like to see knowledge of the business and knowledge of the key drivers of that business. I've heard business owners say that if that machine over there is running, we're making money. I get it. That might be correlated with making money and whatnot, but how much? You know, what's the downtime for that machine? What's the quality for that machine? Are you extracting enough margin from products that are going through that machine that you should be? If I hear comments like we're adding staff and we're growing and whatnot, that's great. But really what I want to see is that there is knowledge about why you are growing, how you're growing in terms of unit volumes, in terms of pricing, in terms of adding new customers. I want to see that over time, you are managing certain variables or certain metrics of your business. And if those improve, then your performance overall as a company improves. Likewise, I want to see if there are certain metrics that you're tracking that you're not doing so well on, then it should correspond to negative performance. And if that happens, then certainly we would want to see an action plan to start improving those metrics. At the end of the day, really what we want to see is that there is a plan or thought around how to minimize the uncontrollable factors and maximize what you can control within the four walls of your business. There's always going to be negative aspects that happen in the economy, with your customers, et cetera, et cetera. You can't fall on that sword, so to speak, and think that that is the reason for your company's performance. Sure, it impacts it, but you've got to manage around that. You're the owner, you signed up for this responsibility, and you've got to show that even if there's some downward performance, you've got a plan to get around it. Now I'd like to move on to what I hear from business owners as it relates to why there is negative performance. Well, first off, as I've mentioned, sometimes we hear that it is all due to factors outside their control. Really what I think of when I hear that is you've got a balloon or whatever floating outside the window, and if the wind blows this way, it goes that way. If it blows that way, it goes that way. Sure, I get it. It can feel like that at times, but I'll just be honest with you. If that's the message I hear, then I'm not going to be excited about the prospects of this management team in trying to overcome challenges. That's not to say that I think the management team is no good, not that at all. It's just there is going to be some learning and a change in mindset to get away from that idea that we're at the whim of the economy, we're at the whim of our customers, et cetera, and change that to we are going to control our own destiny. I also hear about small factors that maybe take up a lot of space in our head, but maybe don't actually correspond to that much in terms of actually negatively impacting the business. So for example, let's say that a key employee quits. It can be very challenging to the business, especially let's say that you have one person that runs one particular machine and every single product you sell goes to that machine. Well, in that circumstance, sure, you could be in a real tough spot. I'd be a little bit disappointed that there's no redundancy at all. You know, having all of your revenues go through one machine with only one person being able to run it, I think that that's a separate issue we could talk about. But for this argument or for this discussion, I think that that type of person leaving would have a big impact. But what I've seen in other circumstances is that there will be somebody that leaves that really frustrates the business owner or really feels like it's going to impact day-to-day operations. And in reality, what happens is if that position isn't filled in the long term, sure, there are going to be negative impacts, but in the short term, the impacts really aren't all that negative. Again, it's this idea that it feels so negative because this person is important and whatnot, but as it relates to actually getting product out the door tomorrow and the day after and the day after that, you're probably going to be okay. Again, not trying to minimize the impact and the importance of certain people on your team. The members of your team should have very big impacts on your business. I guess the point here though is that sometimes the emotional response to a person leaving actually is bigger than the direct impact on short-term, not long-term, short-term results. We also hear about factors that, when quantified, don't correspond to the drop in performance that has been observed in this particular period. For example, let's say that a vendor doesn't ship you product for a week, or a key service provider shuts down for a week. That obviously would have an impact on your business. Now, would it correspond to a 25% drop in revenue? Would it correspond to a 5% drop in revenue? That's tough to say. What I would like to see, though, is the quantification of the impact of that vendor not shipping you product, or the vendor not providing their full suite of services for a period of time.
So what we have here is a fictional income statement that I put together to describe a scenario whenever we hear something to the effect of, our vendor didn't ship for a whole week and it killed our month. Now here you can see revenue being down meaningfully from a budget of 1.2 million to only about 1 million. Gross profit is down. Operating expenses were actually expected to be 371,000. They came in a little bit lower at 341,000, but the end result being that operating income was only 122,000 on a budget of 219,000. If I saw results like this, there would definitely be multiple questions I would ask. The first question might be, what percentage of products go through this vendor? Do all the products go through the vendor? Do some of them? If so, how do you think about the impact of this particular vendor on your monthly results? Another question might be, what changes did you implement once the disruption was known? If no one let you know, what did you do when you weren't receiving shipments as expected? Sometimes your vendors are going to tell you whenever there's a disruption. Sometimes they won't. At the end of the day, though, your processes and your systems need to reflect and need to tell you whenever there is something going on that's not expected. So if you're expected to get 500 parts in on Tuesday and you don't get those, you need to be raising the alarm, especially if those 500 parts are very critical to you being able to achieve your budgeted revenue and income for that particular month. Final question is, what are you doing to reduce your reliance on this vendor? If that vendor is so important to your monthly results, then at the very least, it should be thought about how you can develop redundant sources. I've worked with a lot of business owners, and it's interesting as you talk about who some of your competitors are and whatnot, and they'll say, we've got these 3 competitors, there's nobody else in the industry. Well, once we do some digging and actually research, go online and look for companies like this, there's a lot more competitors oftentimes than the business owner thought. The reason why I give that example is just that if there are more competitors than you thought there were that you can uncover via research, then there are probably other suppliers and vendors that might be able to do this for you than you know of just off the top of your head. A big question, though, as an owner looking to sell, what is the key takeaway from this? My key takeaway is that as you look at gross margin, your gross margin only drops a little bit, or let's call it 2.5 percentage points or 250 bips. But look at your operating margin, a drop of 18.1% to 12.2%. As we all know, business values are based on a multiple of income, and a performance drop of like this, if it's sustained and lasts for more than just 1 month, it's going to have a very serious impact on your valuation, whether you want it to or not.
Another factor I hear often is when business owners will cite factors that don't really describe the results. So they might say something along the lines of, well, we were really facing a lot of pressure here, and that makes sense. There's some downward performance there, but it doesn't describe or explain downward performance in other areas, or it doesn't properly explain the magnitude of the downgrade to performance.
Slightly different income statement here, and also a slightly different response from a business owner. Perhaps the comment was that our vendors increased prices 3% across the board, materials, insurance, utilities, you name it. Okay, that's pretty negative. I guess my initial question would be, what price increases did you experience for the various expense line items? So you mentioned materials, insurance, utilities, etc. I just like to better understand, were they all exactly 3%? That sounds a little bit hard to believe. What would they be? Did these cost increases occur this month? Are they set to take place, last month or in future months? And so those are all important, but perhaps even more important, I would say, is why is revenue down? Sure, your cost might be up, but that doesn't necessarily explain your revenue. And also, why are your operating expenses up slightly on lower revenue? So I get it that price increases can have a very meaningful impact on your gross margin. I mean, here we're looking at a difference of, let's call it 5.9%, which is huge. But trying to portray that your negative performance is only due to increased prices from your vendors is definitely missing the point in this hypothetical example.
I've talked about what I hear regarding negative performance changes. Well, what are some of the responses I hear about positive business changes? You want to know the worst answer I've ever heard? I was talking to this business owner, been around for about 30 years, okay? This business has. What he told me is that, well, I don't know. I think my name's just finally getting out there. So you're trying to tell me that even though you haven't done anything different, it's taken your business 30 years for your name to finally get out there, whatever that means. And that is why your business has recorded an uptick in performance. I'll be honest with you, that's a little bit hard to believe, and I'm just gonna throw that right out the window. Now that's one of the worst answers, but there are some other answers out there that aren't so great. For example, one I often hear is that other competitors or other suppliers just can't do it, and that's why we're getting the business. I understand that, and I'm sure that from time to time, your customers will say that to you, but I've also been in situations where the company that we're looking at is offering the product or service at a price that is so low that no one can offer that product or service at that price. Now, the customer can rightly say, nobody can do what you can do, but what they should also be saying is, at the price that you're offering it. In these circumstances, it's not often that it's a situation of the product or service being that technically complex that nobody else can do it. It's just nobody else is willing to do it at that price. It's great that the company's getting some additional business, but it just raises a red flag about whether or not they are getting the margin that they need to, not only for this new business, but for their entire portfolio of revenue and products and services. The final thing I hear about positive business performance is actually something I don't hear, and that's failing to take into account a really strong economy. Now, again, a big part of this has been talking about controlling the uncontrollable, and that goes both ways. But if we're in a really strong economy, I think you lose a little bit of credibility if you don't at least mention that overall the industry is doing very well, and to some degree you're benefiting from that. Now, I'm not saying that you have to firmly believe that. You can still point to other factors that are more meaningful in terms of why your business is improving. But if nothing else, just to maintain credibility, I think it always helps to at least discuss a strong economy, if you're in one, as having an impact on your results, though one that would be hard to quantify. Now, I've talked about some reasons business owners offer whenever there's negative performance, and also some reasons that I've heard regarding positive performance. Now, what I'd like to do is talk about what I would like to hear or what I would like to see whenever there has been variability in the business, whether it's positive or negative.
So here we have the hypothetical income statement based off the first example, and I've added a column to show the percent change. So what you can see is that revenue is down 17.3%. You can see that COGS actually have a positive variance of 13.2%. And this might be surprising, but again, as it relates to this particular calculation, the only relation is whether or not the actual number is larger or smaller than the budget. And in this case, the actual result is smaller. Therefore, that's considered to be a positive variance since this is a cost line item. Moving on to gross profit, you can see that gross profit is actually down by 21.5%, with the gross margin being down 5.1%. As a relative basis, not in terms of the actual calculated difference, 48.7 minus 46.2%. Similar story for operating expenses. This number is actually lower, so that corresponds to a positive variance. You can see operating income at 44.2% down and operating margin down by 32.6%. Again, this is the example where we heard a business owner say that our vendor didn't ship for a whole week. Well, the bad news here is that this particular month, we're looking at operating income that is down by 44.2%. I mean, you can see it's down, and maybe you don't think that much of a difference because it's only 1 month and it's only it's not even $100,000, but 44.2% is a big number. If you look at what the effect on the valuation might be, if you have just 1 month of revenue down by 20%, it could have an impact on valuation of negative 3.7%. 3 months would be about 11, 6 would be about 22, and all 12 months about 44.2, given, assuming that we have the same margin profile as we did in that hypothetical income statement. So who's to say how many months of revenue being down by 20% you would have? The point here is just to show how big of an impact 1 month can have on your overall valuation. And I also want to encourage you to expect that downward performance, even if it's just a couple of months, is definitely going to be talked about in relation to what the valuation will be for your business. So the first step was a percentage variance. Now let's do an actual dollar variance. And this is related to the example whenever we heard cost increases across the board, materials, insurance, etc. What you can see is revenue is down by $73,000. COGS have a negative variance of $9,000. And you can go through the various other line items, gross profit, operating expenses, et cetera, et cetera. Now, based off this analysis, what I would say to the business owner is that this isn't just a situation where you have cost increases. You have revenue that's down. You have operating expenses that are slightly up as well, only $4,000. So you could chalk that up to not being meaningful. But if you are only looking at this from the perspective of our month got killed because of a 3% price increase from some of our suppliers, I think you're totally missing the bigger picture. And that is going to look negatively upon your ability to manage and analyze the financials when talking to potential buyers. Moving past analyzing the results based off of a percentage and dollar variance, I also think it can be instructive to look at mix. And what mix might be is different products or different services that you sell to your customers. And for some companies, they won't budget on a individual product or service line. That's why you can see in this budget column for products A through C and service A and B, you have question marks. Just to build this out a little bit, I went ahead and put in hypothetical targets for units, hypothetical targets for margin, as well as a COGS buildup based off a product line. What you can see here is that in terms of units, you're not looking too bad, only down 3 as compared to budget. Now, if you do that level analysis, great, but I think you're really missing the boat if you don't take the next step, which would be to perform a margin analysis here. The reason why the margin analysis is so important is because it would take into account your margin for each product. And I know for many, this is going to seem so simple and straightforward, but a lot of people don't understand that shipping more of product A is not necessarily as good as shipping more of product B. And also, sometimes that you make more on product A versus product B, but you don't have a feel for how much more. And also, you got so many products. Some people have hundreds or thousands of products. You can't possibly have a feel for margin on each one of those. And that's why developing a budget for margin on a product basis is so important. So what this all translates to is an impact on COGS where you are showing a positive variance because of the number is actually lower. But when you go up to this gross margin figure, what you're seeing is a reduction to gross margin. The point here is that the analysis needs to be complete in terms of units, in terms of margins, to be able to get to a point where you're able to make a meaningful decision or a meaningful strategy as to how to correct this downward performance. It's not just enough to know that your units were the same or that your margins were down. You need to get in there on a more granular level to determine what the performance should have been. Another type of analysis we'd like to look at is billable hours. We also look at billable hours, if you will, in the manufacturing setting. We don't call it a billable hour, but it's the same concept. Here you can see that the budget was 4,500 for billable with 500 hours not assigned to customer work. The actual was 4,100 and 900 respectively. Negative variance of 400 for billable hours. As it corresponds to the actual results, you see revenue of 1.2 million, budget 1 million actual, revenue per labor hour of 269 versus 244. Now where you get to the variance analysis is first you will do a labor hour variance. The labor hour variance was 400. That corresponds to an impact in dollars of 107,000. Then the next step would be a labor efficiency variance in terms of revenue per labor hour. You can see that would be 25, which is the difference of these two figures. That corresponds to an impact of 101,000, with the total revenue variance being 209,000, which equals the variance that is calculated just by taking the difference between these two figures. Another type of analysis you can do is to peg the analysis based off of your actual revenue performance. So here, instead of comparing everything as if we expected to achieve 1.2 million, it's based off the fact that we actually achieved 1.138 million. Now, based off 1.138 million, the new expected figures would be 555,000 in gross profit, 371,000 in operating expenses, and 184,000 in operating income. What you see here, though, is that there's still a variance. And the reason why I like this analysis here is that you can see that based off of this new revenue figure, your variance in COGS is actually 67,000, whereas in the prior analysis, it was showing that there was a variance of 30,000. This variance of 30,000 in effect is hiding the fact that your gross margin decreased materially from budget to actual. The next step of analysis that you might perform will result in my favorite type of chart in Excel, and that's called the waterfall. Let's create that right here. We'll select the data, then go to the chart section, and we will select the waterfall chart, which is right here, and this type of waterfall. The point here, or the end result of this chart, is that you start with a budgeted number right here of 438,000 for your budgeted op income, and it walks you through the various impacts to get you to what your actual operating income was. Now, once you create this, you will need to modify it a little bit. So we need to select this point over here and then go down to say set as total, and boom, there you have it. You have a budgeted operating income of 438,000. There is a decrease of 282,000 based off of revenue. COGS is showing a positive variance of 52,000. SG&A is showing a positive variance of 26,000. Resulting in actual op income of 235,000. Now, what I will say though is that this analysis does hide certain factors. What this analysis is hiding is that your gross margin over here actually decreased from 48.7% to 44.4%. The point here is that you don't want to look at COGS and say, oh, it's a positive variance, that's great. You really need to look at it in terms of how your margin change from budget to actual as well. So this might be the first step where you create a waterfall that compares budgeted op income to actual op income. Another waterfall you might do is for revenue. And here what we would do is we would follow a similar process to create the waterfall chart, which is right here. Let's go here and we'll set this as total. And the point here is that you have a budgeted revenue of 2.4 million, actual revenue of 2.1. And here you have various reasons that are making up why your actual revenue was less than your budget. Now here I just have hypothetical reason 1, 2, 3, and other. The point here, though, is you really want to be careful that your other category isn't too great. So right now, the actual revenue is a negative variance of 282,000. Your other category is 151. Is that okay? Sure. Maybe, maybe not. Again, this is for your purposes. The point is just that you don't want reason 1 to be maybe -2, -5, -10,000, and everything else gets lumped into other. Because if you do that, I don't know really what the point is of performing this analysis. If it's helpful for you, that's great. I'm just expressing a little skepticism if you don't break it down a little bit further.
Now, after doing all that, I want to take a step back. If you've watched any of my other videos, or you know the approach of 4 pillars, what you'll often hear is that we're not spreadsheet focused, we're more about the relationship, more about the story, more about the people. After going through that section, it could feel like, oh my gosh, these guys are no different than anybody else, all they care about is spreadsheets, etc., etc. You're free to believe that, you can believe whatever you want, but what I would say is that we definitely try not to take it too far. You know, I could have put together 10, 15 different spreadsheets on this hypothetical, extremely simple income statement and just sliced and diced those numbers 6 ways to Sunday. I'm not saying I could do that because I'm some financial whiz or whatever, not that at all. I'm just saying that it's easy to get into Excel and think, oh, this would be interesting to look at, or this would be interesting to look at. For your business, you really need to look at it, look at the analysis that you do, and determine what is interesting on its own right, but more importantly, what analysis is actually going to lead you to make different decisions. That's a huge key right there. Earlier in my career, I worked in a FP&A unit, financial planning and analysis. And a lot of times we would do this analysis and the results were so interesting. It was like, wow, that is really cool. But you know what? It didn't impact decision making at all. And that's when a light bulb went off. You can do all this analysis, it can be like the coolest thing ever and the coolest charts and graphs and 20 different colors or whatever, but if it doesn't impact decision making, is it really worth it? I think you can make an argument no. That's why you as the business owner, whenever you're doing this analysis, you need to balance the analysis that is interesting and just satisfies your own curiosity with what is actually going to impact the decisions that you, your managers, all the folks in the company make based off of what the numbers are telling you. So the first section has been about historical performance. Now let's talk about future growth plans. There are a couple of answers that I hear regarding future growth plans that, quite frankly, I think are quite awful. First one is sometimes I'll hear in the manufacturing environment, well, if you want to double revenues, all you need to do is add a second shift. Okay, so you're telling me that if we add a second shift, your customers overnight will double their orders? Okay, I don't think that's the case. Another response I hear is that all you have to do is add a sales team, and if you have a sales team, they'll be able to go out and get all the business you want. Okay, that's also a little bit hard to believe. The third one is, well, we're doing this for customer X and it's really working out well for them. We just need to find more customers like customer X and do the same thing for them, and we could have a lot of growth. Okay, yeah, I understand the logic there. But as you look at those 3 answers, obviously a lot of holes maybe in the logic. There's different ways that you could attack them, if you will. However, one common theme or one common response to those would be, well, if all those things are so simple and so easy to achieve, how come you as the business owner have not done them already? I've never actually asked that to a business owner because I don't want to put them on the spot to that degree. But it's absolutely something that we ask in our own heads and try to analyze. And if we hear answers like that, then for better or for worse, we are going to think much less highly and put less stock in whatever growth plans that business owner might be talking about to us, because it just doesn't feel like they've really thought it through or really have the conviction that these types of growth strategies will actually lead to growth and not just wasted money. So that was the very worst answer. I will try to move up in terms of how bad it is to slightly less bad to still kind of bad. So the next answer that sometimes I'll hear is, well, we expect to grow 5 to 10% next year. Okay, great. Where's that growth expected to come from? Well, just the industry as a whole is doing well. Our customers are doing well, and the industry's growing. Okay, so are you seeing an uptick in orders from your customers? Have they communicated that they're expecting to grow 10% as well? essentially what I'm saying is you start peeling back the onion and there isn't a lot of rigor, or I should actually say there's no rigor in terms of how they actually arrived at that estimate of 5 to 10%. In those circumstances, a lot of times what they're saying is either, well, the industry as a whole is doing well, we expect a rising tide to lift all boats, and because of that, we think we're going to get our piece of that. Or on the other side, which is probably even worse, it's just they think that the buyer wants to hear that they're going to grow, and so they tell them what they think is a reasonable percentage of growth just to make the buyer happy. Either one of those are not the greatest in terms of really selling a buyer on how likely growth is. We also sometimes hear something to the effect of, well, our current customer X would also like us to do Y for them, and this is a huge growth opportunity. Okay, great. I mean, this is starting out really good. Okay, so what is it? Talk to me about what's going to be required and this and that. And from here, it could go any one of a million different ways. However, in the circumstances where it actually is more of a negative than a positive from our eyes, is whenever there really hasn't been any work and there feels like there is just a very low likelihood that this is actually going to work out. Whenever we talk to business owners about growth prospects, we want an honest and earnest discussion about what really are those prospects and what they could be. Like, we don't want to hear about, oh, well, if this and this and this and this and this and this happens, then boom, we are going to be set. Might feel like we are asking you to just paint a picture for us about how much your company can grow, but no, we're trying to be realistic. We're trying to use these discussions as the starting point for a future partnership. And if we hear answers, or if we learn about a potential prospect for growth with a current customer that really hasn't been fleshed out and honestly just seems like it's more pie in the sky than anything, I'll just be honest with you. I mean, it's not helping develop the partnership to a great degree. Not going to say that it's hurting the partnership at this point, but it's not making it any stronger. That much is for sure. Now, this isn't the final type of response we hear, but it's the last one we'll talk about that we hear somewhat commonly, and that is that the past trend of growth is expected to continue. However, when asked or probed as to why the business owner expects that growth to continue, or at least to be maintained, there's no real good answer. Sometimes what we'll see is a company that has historically, let's just call it, been at 20 million of revenue and maybe 4 million of EBITDA. So, 20% EBITDA margin. And then all of a sudden the company grows to 28 million and margins increase even further than the revenue increase. When talking to the business owner, the answer we might get in this circumstance is absolutely growth is going to continue. We think, the next year revenue increase is even going to be higher, et cetera, et cetera. It's a fun story to want to believe in. It's definitely great to be a part of a company that is growing, but how can you really demonstrate that a year in which you had almost 50% revenue growth not only will continue, but even less than that? What evidence do you have to show that new high that you've achieved of, in this case, 28 million, is going to be maintained? Oftentimes we've worked with sellers, and after looking at the customer buying patterns, we've been able to see that there's a big anomaly in one particular year that was expected to continue and it didn't. Now, I'm not trying to say that we're going to be negative on every potential customer growth story that you talk to us about. Not that at all. We just want to hear some sort of evidence or some sort of thought process or logic as to why that might continue. Do you want to know the easiest way to try and tackle this? Talk to your customer. I know it sounds completely simple, and many of you probably would do that anyway, but ask them what's going on here. Did you have a good year? What are you seeing in your end markets that's leading to this growth? Do you expect it to continue? How long do you expect it to continue? We're thinking about adding capacity to support this further growth. Are you going to need more capacity from us? You're not always going to get a good answer, and sometimes you're going to get an answer from a buyer that is what they're telling you. They think it's 100% certainty it's going to happen. But as we all know, no one has a crystal ball. And so even though that's not perfect information that you can act on, it's better than just making an assumption with no evidence that your growth will continue or your new plateau will be maintained. Now, we talked about what we don't like to hear in terms of future growth. Now let's talk about what we do like to hear. Well, as a starting point, I'm not sure if you're familiar with the term zero-based budgeting or $0 budgeting, but essentially the concept is that, if you spent $10 with a vendor last year, then in order to determine your budget next year, don't start at 10, start at 0 and make an estimate as to what you will actually spend with that vendor. Same exact story with customers. When looking at future growth and future growth plans, I think it's important to look at it on a customer by customer basis to determine what you can reasonably expect from that customer going forward. Now, I get it. I mean, there might be some customers that are buying 100 SKUs from you, 1,000 SKUs, I don't know, and it's just not feasible to go through that customer SKU by SKU. And so for some customers, you might have to do it at a higher level. For others, you can do it at a more granular level. But the takeaway here, though, is that I think it would be very hard to do this analysis if you're not talking to your customer. Might be hearing a recurring theme here of how important it is to talk to your customer. I know that this is basic blocking and tackling, and many of you out there might be getting annoyed with me for bringing this up repeatedly, but I just can't overstate how important it is to have regular discussions with your customers. Pardon the digression, or I apologize for letting this digression continue, but I mean, just think about it. At the end of the day, who do you want your customers to do business with? Do you want them to do business with company XYZ, or do you want them to do business with a specific person on your team? I mean, I can see the compelling argument to say, well, we're a big company. Joe in sales, he might not be here in 2 or 3 years, and we want the relationship to be at the company level. I get that, and it's a valid risk because of how much people are changing jobs and whatnot these days. But at the end of the day, people want relationships with other people. They don't want relationships with companies. And if you continue to have relationships and conversations with your customers, it's going to be harder for them to leave, and you're going to get more information than your competitors will. So I know many of you are already doing this and getting tired of hearing me talk about it, but I just can't overstate the importance of talking to your customers frequently on a recurring basis. Not always only because you need to talk to them, but having those conversations so that as soon as something comes up, you're going to know it, and you're going to know it before anybody else does, particularly any of your competitors. Another thing we like to hear about future growth are meaningful micro developments. This might be a competitor going out of business. This might be a customer adding another facility or adding another shift. Now, there's always going to be micro and macro trends that could hurt or help your business. In these circumstances, though, the ones that are usually the most interesting to us are the micro developments, because those are typically felt more acutely, if you will, by the company itself. Now, sure, regulation changes and whatnot, or huge macro trends can be very helpful as well. But again, a lot of the times those huge trends are going to benefit everybody, which is good, not just this particular company. So throughout this, gave a lot of examples, a lot of general examples that we have heard, and can't share all the details because of confidentiality, and I just don't want to talk about some of the conversations that we've had, but would like to give some examples that I've actually experienced either at the companies I've been running or at some of our portfolio companies. Now, this first example was a conversation that the president of our portfolio company, Southwest Steel, had with one of our customers. This was a customer that, I'll be honest with you, we messed up on a few of their projects, and we have been trying to rekindle the relationship. In one of the conversations that we had, we heard from this customer that their current vendor has made some changes and therefore is not as, I would say, not viewed as strongly as the right vendor for them to use going forward. That's a really positive sign, and that is something that as a buyer, I would take more stock in. Now, there still is a lot of ways to go in terms of actually taking that conversation from just a conversation and actually having it correspond to increased revenue, increased profitability. But that type of discussion where there has been a change at one of their other vendors is the type of messaging that we like to hear that we feel like really could have an impact on that particular customer relationship. Another conversation that we've had recently was at the aluminum die casting company, Dart, it was with a customer that we had, or actually a prospect that we had been talking to for many, many years. And this most recent conversation changed a bit because now the prospect needed quantities that were much, much higher. Well, this was really great news for the company, not only because it was a larger revenue opportunity, but because these higher order quantities would justify the purchase of a machine in order to do a section of the processing for it. You know, in the past, the quotes were not competitive because, in our belief, our competitors had that piece of equipment already and were able to be more cost effective on that product. Now that the order quantities went up dramatically, we were able to justify that and get our costs, you know, in line with what that customer was expecting. And the great news is that, you know, we haven't formally signed the contract, but it's expected that we're going to win that work. Another positive that we like to hear is when prospective customers come to our companies and say, our current vendor is not working, we need somebody else to help us deliver this product or service. For some of our companies, it happens more often than it does for other of our portfolio companies, but it's still the type of message that we like to hear, that we really put a lot of value in and feel like is more meaningful or has a higher likelihood of actually turning into some revenue. If you have a prospective customer that has been spending money for this product or service in the past and they're not happy with their current provider, that is definitely a great opportunity for one of our companies. Finally, getting back to more of a data approach is whenever a company can demonstrate that quoting activity has been meaningfully higher than in prior periods. Now, if you're really advanced, you can show, the funnel of your quoting activity from initial request to gathering data to actual proposal sent to follow-on conversations or whatever stages in your funnel you have. But the point here is that if you perform this analysis, collect that data over time, then as the activity increases, it's more meaningful to us as a buyer, because then you can say, well, over the past 3 years, our win rate is 4% or 20% or whatever that percentage is. We've had a 20% uptick in quotes. These quotes are, based off our analysis, are right in our wheelhouse. So we expect that win percentage to continue. Now, I'm the first to admit that it doesn't count until you actually get a purchase order and you sign the purchase order. But having that level of data and analysis so that you are able to make a forecast as to what this increased quoting activity would translate to in terms of projects that you win is very meaningful. And I glossed over what the first important part was, and that's just the fact that you're able to say that quoting activity has actually increased. A lot of times we'll talk to business owners and they won't have a good feel for whether or not their quoting activity is higher than normal, lower than normal, or about the same. Well, to all those folks that were able to find super strong coffee and were actually able to make it to this point in the video, I congratulate you, but I also realize that you might have made it this far because I struck a nerve with what I said was either a good idea or a bad idea. So which one is it? Did I piss you off with any of the answers that I listed as what a buyer would not like to hear? Or was I way off in terms of what I said that a buyer would like to hear? Let me know in the comments, and if you're really upset, book some time with me so you can just give me an earful directly. Thanks for watching.